get a little bit more on the broader mood of the markets. Michelle Schneider is the Managing Director of Market Gauge Group. Mish, good morning. Nice to have you with us as always.
Good morning, John. Great to see you.
We're always trying to take this temperature, figure out the sentiment of investors. Where do you weigh in?
Well, certainly this rally that we've had over the several weeks has been very welcomed, and in fact we cleared some good technical resistance when we cleared the 50-day moving average in a lot of the indices. So if you're just sort of thinking like a quant model, that was reason enough to go long. But also, because we're looking at the fundamentals, the range of what we were expecting it to reach is pretty much there. So if we just look, let's say, at the SPX, 4170, 4200 would have been our max target. If we can't get past 4130, 4140, I did send you a chart. I don't know if you got to see it. It's a momentum chart. And what's really interesting is that every time the momentum in the SPY has gotten to this point of really high, sort of overbought kind of thing, the market has come down. So we wouldn't be surprised now to see that all of the enthusiasm on the better than feared earnings, the fact that the Fed, so far, people seem to feel like they could actually succeed in a soft landing. We, of course, are more skeptical about that, has created this rally, and we'll see what happens from here, but I wouldn't get too bullish at these levels.
I'll tell you, anytime you've got a chart, we love it. I'd hold the chart party. I love charts, too. I do want to just kind of look at some of the other factors that have weighed into sentiment. Just a note out from the JP Morgan desk today, going through various reasons why stocks might have been rallying coming off in the U.S., the June lows. They talked about so-called short covering. They talked about that rally we saw in technology, people giving it a second look, thinking, well, I guess if things are kind of weak out there, maybe those big tech names are worth a second look. But also earnings season itself providing a little bit of confidence. How would you characterize what has happened so far during earnings season from your vantage point?
Well, what's interesting is that the money went into pretty much the top 10 companies. And yes, part of it was that the yields have fallen, the dollar has fallen. Part of it is because, as I said, better than feared earnings potential for, let's say, Apple and Google and Microsoft. They all did better than people thought. Amazon, partly because we had some money coming into consumer discretion. But if you look at the PE ratios, they're still pretty high in the top 10. So anything to do with tech and cloud is still getting the kingpin of the money because they have billions of dollars that go in there and they do a lot of research and development with that money. If you look at the PE ratios of the smaller cap companies, of course, they've dropped tremendously more to around 15. So essentially what you see right now is that initial thrust of money coming into the big tech, the high growth stocks, and the small cap stocks being a little more realistic. So what's going to really happen from here right now, because earnings is going backwards, not forwards, is going to be what happens with inflation, obviously. There's the broad CPI versus the core CPI. And if you look at the difference, the core doesn't show food and energy. You put in the food and energy, and the broad CPI is much higher. You still have geopolitics all around you, obviously China, Taiwan, now the latest buzz. Mm-hmm. And on top of that, there's still food shortages. And even if energy sort of, you talked about it before I came on, even if it flatlines here, if you go back to the 70s, you had oil peaked first. You had grains peak first. And that's when inflation went crazy more towards the precious metals. And I think if you have to watch those bonds right now, because the credibility of the Fed is everything. If the yields stay soft, especially after the whole hawkish talk we've heard over the last several days, that tells you that the Fed, A, is not really in control, and B, if the bond yields start to outperform the SPY, that means now not, oh, great news, yields are down, everybody could come in and buy, more like, flight to safety in bonds, something that has not been a flight to safety this year. And if it starts to outperform the SPY, that's telling you now that things are really going to possibly get dicey. And it's going to be that dance between recession and inflation. And you know the word we like, John, stagflation.
Yeah,